My name's Gareth Chatkin, and I'm a tax senior manager here at Richey May. Today we're going to go through the anatomy of a K1 and the related footnotes so that as a partner of a fund, you have a better understanding on how to interpret your Schedule K1, which can be confusing at times. So to kick it off over here, we have a standard K1. This will be no different from any other K1 you receive, whether it's from a fund or real estate partnership or whatever other partnership, it will be the same. So we'll go through what a typical fund K1 looks like, including the related footnotes, and briefly touch on the new Schedule K3. So again, as mentioned, what you're looking at over here is the face, page 1 of the K1. Starts off with the partnership information at the top in part 1, followed by part 2, which is information about the partner, and then to the right of that you have all the taxable line items that make up a K1. So we'll kick it off on and talk about part 1 and part 2. So part 1, we see over here on the right, we'll start with the partnership's tax identification number. So in most cases, this is going to be the partnership's EIN, followed then by the partnership's name, the name of the fund, and its address. If it were a publicly traded partnership, it would mark box D to select a PTP. We're then followed by part 2, the information of a partner. Again, start off with the partner's tax identification number. This could be either the partner's social security number if it were an individual or a trust, or the EIN if it were a corporation or another pass-through entity like a LP or LLC. After that, we see the name of the investor, the name of the partner, and their address, followed by then item G, indicating if this partner is the general partner of the fund or if it's the limited partner or other LLC member. This is then followed by whether the partner is a domestic U.S. partner or if it's a foreign partner. This box will be checked. And then we have some new information from 2019 where you see the disregarded entity information of a partner. We're going to spend a couple minutes talking about this because this is where we get the most questions on this section, and it is because of the new disregarded entity reporting requirements. So 2019, the IRS established reporting requirements for Schedule K1 for disregarded entities. And a disregarded entity is an entity that is recognized under applicable state and other local tax laws, but is ignored for federal tax purposes. So a disregarded entity is an entity that has a single owner, is not organized as a corporation, and most importantly, has not elected to be taxed as a separate entity for federal tax purposes, right? So examples that we see, number 1 over there, single owner eligible entities that have not elected corporate treatment. So the most common ones we see over here are single member LLCs. You have qualified S Corp subsidiaries, qualified real estate investment trust subsidiaries. Another common one we see are grantor trusts. Grantor trusts are where the owner who creates the trust is the sole owner of the assets for income tax purposes. And again, single member LLCs and grantor trusts are the most common what we see. So how do we report the disregarded entity information on the K1? So we move to the next slide. We see that disregarded entity information should be entered into part 2, again, information about the partner. So starting on item E, over here, we're not actually going to list the disregarded entity tax identification number. If there were a separate identification number for the disregarded entity, we're actually going to show the beneficial owner's social security number, or if the beneficial owner were another entity, we'd show their EIN here. But most cases, this is the beneficial owner would be the individual. This is then followed by item F, which will be again the beneficial owner's name and address. So again, we get a lot of questions asking why don't I see the actual disregarded entity information here? That is not the way it is reported now. We have to show the beneficial owner's name and the beneficial owner's address. Then we move to item H2 of this section, where over here we would then show the disregarded entity information. So we would show the disregarded entity's tax identification number. So if there were, for example, a single member LLC that has a separate EIN, we put the EIN of the single member LLC. Oftentimes for grantor trust, there is no separate EIN. So in most cases, we would just put the partner's social security number because it would be the same. It would be the same regardless. And then next to that, you'll see here in this example, we have John Smith 09 Trust. So again, we put the disregarded entity information over here. So if it were a single member LLC, the LLC name would go over here. And then the last item, I1 over here, what type of entity is this partner? Again, this would not be the entity type of the disregarded entity, but rather the entity type of the beneficial owner. So again, most cases we'd see an individual over here. So I know that can be a little confusing, but these rules have been changed, and it's important that we that we follow along accordingly. Moving on to the next slide, before we jump into the next section of the face of the K1, which is Part L, which is the partner's capital account, it's important to understand how we report the partner's capital account. And in order to do that, we need to have a basic understanding of book versus tax basis. So we'll start with the easy one first. On the right there, book basis. This would be taking into account your cash contributions, your book income loss, and any withdrawals or distributions. So this would look the same as your monthly, quarterly, or annual investor capital account statements, because that is reported on book and GAAP purposes. Then to the left, we have tax basis. A little similar to book basis, but with more to it. Contributions, again, if it's cash contributions, would be the same that you report on book basis. And your taxable income loss, any tax exempt income you would add. So this could be interest income that is not subject to income tax, such as bonds issued by any states, cities, or counties, or other municipal bonds, etc. We then subtract your any non-deductible expenses. Example of this could be fees and licenses, federal income taxes, and fines and penalties, and meals and entertainment expenses that are non-deductible. We would subtract that. We'd also subtract any guaranteed payments to the general partner. Again, subtract out any withdrawals and distributions. Again, if it were cash distribution, this would be the same as what you report under book basis. And then you would take into account your liabilities. Now, item L, item L of the section L of the K1 doesn't include liabilities, but the previous section will show your liabilities. So it's important to take all of that into account when calculating your tax basis. So moving on, a little more information about tax basis. So we're now required to report tax basis, your tax basis capital account on Part L of the K1. You see over here, using tax basis is determined by the transactional approach. Again, the transactional approach, which the IRS does prefer. Again, it's just another name of the tax basis method. The instructions do make clear that the partner is responsible for maintaining its adjusted tax basis in the partnership interest. and the amount reported on item L, so section L of the K1 by the partnership may be different from what the partner's tax basis is in the partnership. So this is very important to understand, and we do get quite a lot of questions around this, but it is the responsibility of the partner or the partner's CPA to track and calculate their tax basis outside their partnership. So this would be considered outside basis. And normally it's best to perform some sort of K1 reconciliation with your separate outside basis calculation to what's being reported on the K1 to ensure your tax basis is being reported accurately. So it's mentioned. So the K1, as mentioned before, is reported on inside basis. So what you see on the face of the K1 is essentially the total value of the fund being broken down and passed on to each partner. Where outside basis is each partner sharing the fund based on their personal investments into the partnership. So it's important to, again, it's very important to track your own outside basis in the partnership and ensure this is reported accurately. The last 2 points you see over here are related to negative tax basis, and negative tax basis was really the main driver for this change, that the IRS now requires tax basis reporting, because the IRS needs to know what the partner's tax basis is in the fund. If a partner has a negative tax basis account, when it comes time for the sale of the partner's partnership interest, well, the partner's gain from the sale of his partnership interest will generally exceed the cash he receives if we're showing a negative tax account, and that simply just cannot happen. So a partner's negative tax basis account must be supported by an allocation of partner's liabilities to the partner. So if the partner's share of the partnership liabilities is smaller than the negative tax, than his negative tax basis account, then most likely the partner will need to recognize a taxable event as a deemed distribution in excess of his tax basis. And again, this isn't something that is very possible, and is a red flag to the IRS, and they now require that it be reported. So again, going back, that's why it is important for each partner to track their own outside basis, because there could be times where you show negative tax basis on your K1, but you may not actually have negative basis. So these two items are what really drove this change, and is important to adhere to. So moving on to our example. So on the top right over here is item L, your partner's capital account analysis, and again, as mentioned, needs to be reported on tax basis. Normally on the footnotes of the K1, as you can see below, it'll show the taxable income or loss of the K1. If this normally would match your current year net income loss that you're reporting. Again, and here in this case, we see $390,000. If there were any line 18, which are your tax exempt income and non-deductible expenses, the amount would be off by those amounts. So important to just recognize that if you see that these numbers don't match, don't be alarmed. Take a look to see if you have any tax exempt or non-deductible expenses, and that could be the reason for the difference. And in some cases, there could be a transfer of partnership interest. This over here we have none, but this would normally be shown as other decreases. And again, as you can see in the footnotes, the middle section there, the total other decreases none. So we know we don't have any other increases or decreases that are affecting the tax basis. And the last section, which sometimes you may see a reconciliation to your book or GAAP capital account. So in this case over here, we see the partner's book capital account, and you include their taxable income. You take the partner's current year unrealized gain or any other temporary or timing differences of the fund, which will be shown here, which is a reconciliation to a partner's book income, and that will then get your the partner's ending book capital account. And this would this should match up to the investor's capital account statement. So it's always good to check and ensure that this is all being calculated correctly. Moving on, and before we get into the actual K1 and the related footnotes, want to just spend a little bit of time talking about trader versus investor status on a hedge fund. And the reason is because certain line items and certain footnotes will be reported differently, whether the fund is considered an investor fund or whether it's considered a trader fund. So many firms, many tax preparers, should be completing a trader versus investor analysis every year for a fund. Now, this isn't it's not a formal election that needs to be submitted with your tax return or with your Schedule K1. It's an informal annual assessment that needs to be done in case there was ever a notice or an audit. You have backup support showing that you've done this analysis to show whether you're an investor or trader, because as you'll see coming up, it is more beneficial to be considered a trader. But again, very important to do this analysis and make sure you always have the support and that it's done on an annual basis. So to successfully meet the test for trader status, the IRS says the trading must be substantial. So what does that mean? There isn't a lot of guidance out there that the IRS has released on that, but some of the traditional factors that need to be considered are the frequency of the trading, right? The portfolio turnover, how quickly our securities in a fund are being bought and sold, the holding period, short-term versus long-term capital gain losses. Again, if it is more short-term, that's more indicative that it would be a trader fund because of the portfolio turnover. And then the nature of income derived from the activities. So traders must be active in the market on a daily basis and attempt to profit from short-term swings in price movements. So that's what would be looked at over here to determine if the trader status would apply. So moving on, the differences between investor versus trader status. So since the Tax Cut and Jobs Act, investors for an investor status fund are no longer able to deduct miscellaneous itemized deductions. So that would be management fees, administrative expenses, and any tax preparation fees. On the other hand, a trader status, investors of a trader fund are able to fully deduct management fees and administrative expenses related to trading income as business expenses, right? So as a trader fund, you're now able to deduct those expenses, which again is a benefit of a trader fund. Not on the slides, but trader funds, if a fund is considered a trader fund, it's worth to consider if you can make a mark-to-market election under Section 475F. And really what this mark-to-market election does is any gains, losses, so any realized and unrealized gains and losses will be treated as ordinary income loss. So your unrealized gain losses would be mark-to-marketed and would be treated as ordinary income or loss, which again is similar to the short-term capital gain rates, which is why it is an important factor. And what this would do too is cut out on a lot of testing and reporting. So a non-475 fund, if there was a lot of trading activity, a lot of times we have to do certain securities analysis, such as testing for wash sales, to determine if there are any losses that are not deductible for that year. Well, in this case, for Section 475 mark-to-market fund, you can cut out on a lot of that testing. So it's a lot simpler reporting. So if your gains and losses are more short-term and you don't really have any long-term losses, it is something that should be considered. Moving on to a K1 example. So we've already spoken about the left side of the K1, where we see the information about the partnership and information about the partner. Looking towards the right of that, we start with line 1, ordinary business income loss. Not something we see on a lot of hedge funds, just because it's more passive in nature. But if there were, if the fund did invest in another fund, like a fund of fund or through a private equity fund, this is where we'd see more of our line 1 ordinary income losses. We have, just moving down, your line 4, which is your guaranteed payments. So this would be any guaranteed payments to the general partner or investment manager. Line 5 would be your interest income. Line 6 would be your ordinary and qualified dividends. Line 8 and line 9. Line 8 and line 9A would be your short-term capital gain losses or your long-term capital gain losses. And then moving down, so you can see line 11, 13, line 14, 19, and 20. You'll see statement. This is because there's generally a lot more information that goes into these numbers. So this information will be displayed on the next footnote page. Then lastly, line 21, foreign taxes paid or accrued, show the number over here, but generally there's normally additional information on the foreign taxes. So moving on to the right of the screen, again, your line 11. So this shows that the amount related to line 11 was other portfolio income on line 11A. There are other line 11 items. A big one is line 11I, but over here we see that only line 11A, there's only an amount on line 11A. Line 13, most common ones we see over here are line 13H and 13W, which are your investment interest expense and your other deductions, which can include management fees and other fund expenses. Line 14, again, just indicating the net earnings from self-employment. Again, normally the guaranteed payment to the general partner. Line 19, distributions. Over here, we see that the distributions were cash. So line 19A, cash and marketable securities. If there were a property distribution, it would be indicated here under line 19C. So this line would distinguish accordingly. Line 20 will show your summary of investment income and investment expenses. And again, line 21, as mentioned, normally have some details on any foreign taxes paid. Over here, we can see that there were $62 of foreign taxes paid versus accrued. So this is where you'd find this information. Now moving down, some of the other partner-related footnotes. So as shown on a previous slide, you would see your taxable income loss over here and any other increases or decreases. So over here in this case, we see that there was a transfer out of partnership interest. So that information would be shown over here. And then moving on with your standard K1 footnotes. So over here, as you can see, which we've spoken about, the IRS requires partnerships to report capital accounts on a tax basis. The tax basis presented is the inside tax basis based on the information provided by the partnership, but partners are responsible for calculating and tracking their outside basis, which may be different. So we've already spoken about this before, but again, this highlights the importance of really tracking your basis. Moving down the line 6, your dividend income detail. So over here we see that there is that part of the qualified dividends from line or part of the dividends from line 6A qualify for the dividends received deduction, which could be applicable for corporate partners. So very important to pay attention to these footnotes. Another standard footnote, line 9A, moving on to the next page, of long-term capital gains losses. So this footnote is going to be related to section 1061, right? And all that says, or 1061, section 1061 requires a 3-year holding period for an investment fund manager's share of the capital gains. So most likely investment fund managers carried interest or incentive, and basically says that there's a 3-year holding period required to qualify for the lower tax rate of long-term capital gains treatment. So this is something new as of the last couple of years. Investment needs to be held for 3 years or longer to qualify for long-term treatment. If it's only held from 1 to 3 years, even though it's considered long-term after 1 year, if section 1061 is applicable, well, that 1 to 3 year period would not get the beneficial long-term rates. So again, mostly applicable to if you have an applicable partnership interest. Again, most likely the general partner of the fund or the investment manager. So over here we can see that section 1061 is applicable. Capital interest gains or losses under section 1061. We see that 29K is applicable to section 1061. Moving down, line 11A, which we already touched on. So this other portfolio income. So in the previous footnotes, there was a summary indicating that line 11 of the K1 was related to line 11A. And this breaks it down even more of what's included in your other portfolio income. So over here, we can see that your section 988 gains, losses, and other portfolio income losses are included. There could be various other portfolio income, which would be listed over here. So important to ensure that you look at the breakout of those numbers. Over here, we see additional details in your line 13H, investment interest expense. Over here, it would indicate if it was investment expense related to investor activity, or if it's interest expense related to trading activity. So investor activity, now you're not permitted to take those expenses, but a trader fund, you are permitted to take that interest expense, which will be reported on Schedule E. Moving on to line 13W, your other deductions. So again, over here, similar to above, it would indicate the amounts were related to investor status. So over here, we see that this was formally deductible. But so that's why we know that this is an investor fund. Vice versa, if we're a trading fund, it would say it would indicate that deductions would be allowed to be reported on Schedule E on your individual income tax return, your Form 1040. So again, very important to pay attention to these details. Moving on to the next section to the right. Additional information. So over here we see that there was unrelated business taxable income, so UBTI, which is relevant for any tax-exempt investors. So this indicates that we have some ordinary income, short-term and long-term gains that are considered unrelated business taxable income. And again, these would be taxable to any tax-exempt investors. So again, another reason why it's very important to pay attention to these footnote slides. Moving on, continuing with the footnotes. So we see, so these would be the last page of the K1 footnotes, and again, includes other additional information about the K1. And these are the most common fund footnotes we see. So the first one talks about the Schedule K3 reporting. So this was new for the tax year 2021. And essentially the K3 The Schedule K3, which is attached to Schedule K1, just provides some standardized reporting of items of international tax relevance. So again, as mentioned, it's just an extension of the K1, and partners would use this information to complete various forms related to international reporting on their own tax returns. So it may or may not be applicable, but it is required whether or not you have any foreign items on the K1, because you may not have any foreign related items, but it's still now required to file and to report Schedule K3. Moving down, we see again other information. Again, over here, over here it states that the partnership has taken the position that it is an investor in securities and is not engaged in active conduct of a business as a trader in securities. So, if it were a trader fund, it would be indicated over here. So again, there's ample. This should be reported quite abundantly on your footnotes, indicating whether the fund is an investor fund or a trader fund. Moving down, we see line 19, distribution. So this is just standard language. If there were any additional details, such as if there was a distribution in kind, which would be a property distribution, more information would be shown over here. You would have the fair market value and the cost basis of the property distribution. But in this case, we've seen before in the previous footnotes that it was just cash distribution. So we just have the standard footnote here. Line 20, moving on, lines 20A and 20B. This just shows what line items of your K1 are included as investment income and investment expenses. It'll show the exact specific line items that make up your total investment income and total investment expense. Moving on to the next section, which is net investment income. Again, this is more standard language that you would find on a fund K1. This talks about net investment income tax, which is applied at a rate of 3.8% to certain net investment income of individuals that have income above the statutory threshold amount. So this could be applicable depending on your status as an individual investor. So again, important to look through this. Moving on to the right, this talks about investment interest expense limitations. So there are now investment interest expense limitations. This example that we're looking at again is we know that this is an investor fund, and a partnership. If the partnership is an investment partnership, it's not subject to these business interest expense limitations. But if it were a trader fund, trader funds are subject to interest expense limitations. So there's only a certain amount of interest expense a trader is able to deduct. But again, this information would all be here in the footnotes. We're an investor fund, so the footnote is a bit limited. But if it were a trader fund, it would provide additional details. And the investor would have to act accordingly on their own individual income tax return. Lastly, we have state tax considerations. So, generally investing trading activities are generally not subject to income tax in most states. But if there was any state source income, so again, most of the times where we see this, if this was a fund-to-fund or private equity or venture capital fund, this would indicate if there was any state source income and if any state K1s were attached to the federal K1s. That again would show if there were any state income taxes that the investor would have to consider. So that's a general run through of an investor K1, the anatomy of a K1, if you may. If you have any questions, on any of this, or just want to have a conversation, regarding tax K1 reporting, please don't hesitate to contact us here at Richey May, and we'd be happy to help.